The income statement gets all the attention. It's the exciting story of a company's sales and profits. But history's greatest investors, from Benjamin Graham to Warren Buffett, understood a deeper truth. The real story of a company's strength, its resilience, and its risk of going bankrupt isn't found in its profits. It's found in the cold, hard, factual snapshot of its financial position, the balance sheet. In the year 2000, Enron reported record profits. Its balance sheet, however, was screaming danger. In the next 10 minutes, you will learn how to read any company's balance sheet. We will demystify its structure and focus on the three key numbers that allow you to instantly diagnose a company's financial health and make profoundly better decisions for your investment portfolio. The balance sheet is one of the three core financial statements, but it is unique. While the income statement and cash flow statement are like videos, showing performance over a period of time, the balance sheet is a photograph. It is a snapshot of a company's financial condition at a single, specific point in time. Its structure is governed by an elegant and unbreakable formula, the fundamental accounting equation: assets, liabilities plus shareholders' equity. This equation must always balance. Let's define the terms. Assets are everything the company owns that has value: cash in the bank, inventory in a warehouse, machines in a factory, patents on a technology. Liabilities are everything the company owes to others. This includes bank debt, bonds it has issued, and bills it owes to its suppliers. Shareholders' equity is the net worth of the company. It is the residual value remaining for the owners, the shareholders, after all liabilities have been subtracted from all assets. It is what is truly owned, free, and clear. This equation is the foundation of all accounting. It's simple, but it's also profound. Buried within these three categories are the vital signs of a company's health. We're going to ignore the dozens of line items and focus on just three key calculations that reveal almost everything you need to know. What is the first, most critical measure of a company's immediate survival ability? We will assess the balance sheet through three lenses: its short-term health, its long-term stability, and its efficiency. Theory: the three vital signs. Liquidity, short-term health, the current ratio. This measures a company's ability to pay its bills over the next 12 months. The formula is current assets, current liabilities. Current simply means assets that can be converted to cash within a year, and liabilities that are due within a year. Solvency, long-term stability, the debt-to-equity ratio. This measures a company's leverage. It shows how much of the business is funded by debt versus the owner's own capital. The formula is total liabilities, shareholders' equity. Efficiency, return on equity, ROE. This measures how effectively the company's management is using the shareholders' capital to generate profits. The formula is net income, shareholders. Equity. Analogy: a personal financial checkup. Think of reading a balance sheet like a doctor reviewing your personal finances. The current ratio is your emergency fund check. Do you have enough cash and liquid assets to cover all your bills for the next year? A ratio above 1.5 is healthy. A ratio below 1.0 is a major red flag, suggesting you may have trouble paying your bills. The debt-to-equity ratio is your leverage check. How much of your life is funded by debt? A person with massive loans and a huge mortgage relative to their net worth has a high DE ratio and is financially fragile. The same is true for a company. A low debt-to-equity ratio is a sign of a conservative, resilient balance sheet. Return on equity is your capital efficiency check. For every dollar of your own money that you've invested, how much profit are you generating each year? A consistently high ROE, say above 15%, is often the sign of a high-quality business with a strong competitive advantage. Example: two companies. Company A, the Fortress. Current ratio, 2.2. Debt to equity, 0.3. ROE, 17%. This company can easily cover its short-term bills, is funded almost entirely by its own capital, and generates strong, efficient profits. This is a financial fortress. Company B, the House of Cards. Current ratio, 0.7. Debt to equity, 4.0. ROE, 25%. This company is illiquid and may face a cash crunch. It is fueled by a mountain of debt. And while its ROE looks impressive, it's being artificially juiced by all that leverage. A small business disruption could be catastrophic. This is a crucial distinction in any wealth management strategy. Understanding these three ratios will put you ahead of 90% of investors. But to reach the next level, you must avoid two common traps. Pitfall number 1. Ignoring the quality of assets. Not all assets are created equal. A company's balance sheet might be bloated with an asset called goodwill. This is an intangible asset created when a company buys another company for more than its assets are worth. A massive goodwill account can be a red flag that management has a history of overpaying for acquisitions. Pitfall number 2. Analyzing a single snapshot. A balance sheet is a photograph, and a company can dress up for picture day. Companies can and do engage in window dressing to make their balance sheets look better at the end of a quarter. The only way to get a true story is to analyze the trends over at least 3 to 5 years. Is debt steadily rising? Is equity shrinking? The trend is more important than the single data point. Avoiding these traps moves you from a novice to an intermediate analyst, but there is one more calculation that very few retail investors perform. A number that can reveal a company's true, underlying hard asset value. The advanced strategy, tangible book value per share. This is the ultimate conservative measure of a company's net worth. The formula is shareholders' equity, goodwill, intangible assets, shares outstanding. This calculation is profound. It strips out all the accounting fluff, the brand value, the patents, the goodwill from past acquisitions, and leaves you with only the hard, tangible assets of the business. Its cash, its inventory, its factories, its real estate. Value investors use this as a bedrock valuation. They compare the current stock price to the tangible book value per share. If a stable, profitable company is trading at or below its tangible book value, it can represent a significant margin of safety. It's the analytical equivalent of buying a business for the price of its physical assets and getting the brand, the patents, and the future profits for free. Let's distill this into the 3 foundational truths about the balance sheet. It is a snapshot of financial health. The balance sheet is governed by the ironclad rule: assets, crux, liabilities, plus equity. It provides a static picture of what a company owns and what it owes. Focus on the 3 vital signs. You can diagnose 90% of a company's financial health by focusing on 3 key ratios: the current ratio, liquidity, the debt-to-equity ratio, solvency, and return on equity, efficiency. Calculate the hard asset value. The advanced strategy is to calculate tangible book value per share. This strips out intangible assets, giving you a conservative, liquidation-style valuation that can reveal deeply undervalued opportunities. The income statement may be the story, but the balance sheet is the truth. If this analysis provided you with real value, invest a single click in the subscribe button to get daily access to the Codex. Knowledge is the new capital. We'll see you tomorrow.